Hello, everyone. Thank you so much for joining us for another weekly wrap-up. My name is Jeremy Kronemeyer, Operations Manager for Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what's going on in the markets?
Hey, thank you, Jeremy. Thanks for our listeners jumping on another call. Yeah, we saw the U.S. stocks rally for the second straight week. We saw the Nasdaq Composite that was up 4.7%, that Russell 2000, that small cap area, up 4%, and the S&P 500 up 3.6%. We saw WTI crude. Now that fell over 14% to around $96 after topping earlier in the week 117. So tremendous volatility in that area. We saw Brent crude also plunge down with emerging markets that lifted their equities up about 8%. What sectors outperformed and underperformed? Technology, industrials, consumer discretionary, all led the gains. Semiconductors were up about 13%. They hit a record high, but software continued to struggle. That was down 7% after Anthropic delayed an AI model rollout, if you might, for some security concerns. So we saw headline CPI numbers come out. They were up 0.9% month over month, 3.3% year over year. That was the highest that we've seen in 2 years. We saw gasoline drove nearly 3/4 of that increase. Then we looked at core CPI. So that's stripping out food and energy. That rose about 2.6% year over year. Now that did demonstrate maybe some limited spillover, if you might, from the energy sector. So that would be good news. Hopefully it's not, lifting all boats, if you might, with inflation. So we look at the short and intermediate treasury yields. They were pretty flat, with the long-term yields rose after a pretty weak demand for the 30-year in that auction. We saw the FOMC minutes come out suggesting that some of the policymakers were favoring a rate hike to curb inflation. Now, I do want to be straight. That is not our thought. We do not feel that that the FOMC should be raising rates. We do feel it's primarily temporarily, but also with higher prices, with energy, so on and so forth, that could erode demand, which could slow the economy. So we don't think that's necessary. We'll look at the U.S. consumer sentiment that fell to a record low at about 47.6, and the one-year inflation expectations. Now, that jumped pretty good. That jumped to about 4.8% from 3.8. We saw service growth slowed while prices paid and delivery times, they all hit multi-year highs. If we look at the Q4 2025 GDP, that was revised down 0.5% to only 0.5% growth, where we saw the Atlanta Fed's GDP now estimate for Q1 26, they have a growth of about 1.3%. The official Q1 GDP numbers, they won't be released until the end of the month, around April 30th. Internationally, we saw OPEC Plus agreed to a modest May production increase. We saw Chinese producer prices rose, and we saw the Eurozone investor confidence drop to a one-year low amid recession fears and some rising energy costs. Kind of the week ahead, it's going to be dominated by the geopolitical events. That's going to be the headline. But I do want everyone to be mindful there is more than that going on. We've got earnings. Earnings are coming out. And we got some pretty big hitters in the U.S. banking sector coming out, like J.P. Morgan, Goldman Sachs, Citigroup, so on and so forth, setting the tone for this market. We'll also have some key tech names coming out, like ASML, Taiwan Semiconductor, Netflix, just to name a few. But I want everyone to be mindful of that, because what's going to drive stocks really going forward after you leave the geopolitical events, which will hopefully sooner than later go away, if you might. Stocks are going to be driven off earnings. And as long as we have good earnings, I think that justifies higher stocks, higher markets. Even though I do expect some volatility, probably in the short run, because we've had a really good rally in the market over the last, 9, 10 plus days, almost straight up. But overall, we'll be getting some U.S. data coming out, like producer prices, existing home sale, industrial production. Fed Watch always has some Fed speak out there from some of the members of the FOMC. Then international data, we'll look at China's Q1 GDP, industrial production, retail sales, IMF biannual meeting that's going to be held in Washington, and Australia's employment report in the UK GDP that also will be coming out and due this week. Jeremy?
Thanks, Graham. So I had a question for you, since in honor of a tax day coming up here this week. What do you see for our clients, not just thinking about taxes now, but taxes in the future?
Yeah, I think you really have to be mindful of the future, not just now, right? So a lot of time we're so focused on getting those last year information together, provided to our CPAs, our filers, if you might, so they can file a return. But we often forget that we need to be planning for the rest of this year and beyond, right? So we need to think about being tax efficient. What steps can we put in place that maybe we did or didn't do last year that we can do for the rest of the year after, 5, 10, 20, 30, 40 years down the road? Because we're talking about massive tax savings if we can be more tax conscious today and down the road, if not tax-free in our planning process.
Right. Gotcha. Well, Graham, we always appreciate the information and expertise, and thanking our listeners that check in with us every single week. We look forward to seeing you next time, and have a great day.
Take care.